Hello, welcome. Welcome, everyone. Just so you're aware, this will be recorded for those who are not able to make it live. Thanks for being here. We will get started in a few minutes, but you are at the credit workshop that you wish you had in high school. So today is all things credit. This is a workshop that Janice and I host quarterly, each quarter on a different topic. So if you're interested in advancing your financial education, your literacy, get a taste of what coaching is like, these are a great way to hop on and learn something. It's an easy way to commit an hour to yourself and your learning. So let's get started. Today, we are going to talk about all things credit, like I said. And these topics are things that, let's be honest, you can probably Google or look up on YouTube. But what we have done is we have condensed this all down into one presentation so that all you have to do is show up, commit this hour, probably more like 45 minutes to yourself, and learn something and be prepared to ask some really good questions at the end.
All right, some just housekeeping items for today. If you have any questions while we're talking, just write question in all caps in the chat. Um, all participants are going to be muted, and you can also contact us individually if you have follow-up questions. Go ahead, pull out pen and paper and get ready to take some notes. And also, all of the content provided in this webinar is for informational purposes only. We are here to educate and not advise. Every person has a unique financial situation that requires unique attention. The presenters of the content are not responsible for any financial decisions you may make.
Okay, so let's dive into why are you here? Do you feel like your self-worth is wrapped up in your credit score? A good credit score makes you feel really good, but a bad one maybe makes you have a bad day. Maybe nobody told you why you need a credit score, or you don't feel like you actually understand how credit works. Someone told you you need a good credit score to buy a house, but you're not really sure how to make that happen. But maybe what you want is to understand the financial system and how it works. You want to leverage your good habits and you want to learn to use credit as a tool. Well, if that's you, you're in the right spot. Our mission is to leave you with the information needed to make the big money decisions down the road. And make sure to stick around to the end because we have some great free resources for you to download. My name is Dana. When I was younger, I remember my parents saying no when I wanted to buy something. And I was so confused because just a few days earlier they had said yes. So I asked why? And obviously, hearing no is nothing new. Every kid hears that. But that planted a seed of curiosity in me. And ever since then, I've been so curious on how money plays a role in our lives. Now, as a financial coach, I get to help my clients decide how they want money to play a role in their lives. And I get to teach them the systems and the habits so that they can win the game that is money.
And hi, I am Janice. I'm also a financial coach. I got into coaching actually starting through basketball first, wanting to help high school students, become adults. And in my own journey of learning personal finance, I found that nobody or most people don't get any education on financial literacy. And so I wanted to work with people mostly of the high school age, but also older, to be able to support their future goals by understanding how money can help support their future goals. And so that is why I do what I do. And
Awesome.
we will uh, go back to Dana.
So again, why care? Why do you care about credit? Well, there's a lot of good reasons, but for one, the system that worked for your parents probably isn't going to work for you. Credit is a made-up system, and it's made up for the banks to win. We're here simply to show you how to create the systems and make sure that you win the game. We're going to talk about the ins and the outs and the financial literacy of it all, but we're also going to give you some tips so that you can be set up for success. Diving in, what is credit? Credit is a contract agreement between a borrower and a lender that will receive a sum of money or something of value, right? And repay the lender at a later date, usually with interest. Opposed to that is credit worthiness. So your credit is going to be the loan, the agreement, where your credit worthiness is measured by your credit score. And it's what lenders typically, not always, but typically will use to decide if you are safe to lend to and what the interest rate might be of that loan. So, credit scores, first fun topic. This is basically a made-up number. Credit scores are made up of five different categories, and we're going to dive into each of them, and each one has a separate impact on your overall score. And so when I'm going over this, think about what credit score you have. If you've looked recently, if you have no idea, that's okay. And think about how you have behaved in each of these categories and see maybe what that did to your credit score in the past. So each of these five categories are weighted differently to make up your score. And I don't need you to fixate on any one of them in particular, but I do want you to remember which ones are the most important. So your payment history is going to be the most important factor making up your credit score. This shows if you pay your bills on time. So when lenders are trying to figure out if you're trustworthy, they want to know, are you going to pay them on time or do you have late or missed payments? Bankruptcy comes into play here. If you have any bills sent to collection, all of that can impact your score. And with it being the highest percentage, it's the one I want you to pay the most attention to. Your amounts owed is also a pretty big deal when it comes to your score. And what this looks at, it's comparing the amount of debt that you have to the amount of credit available to you. It's called your credit utilization, and it's the amount you're using compared to what's total available. So keeping your credit utilization low is going to help your overall credit score. So think about it. If you have, let's say, a credit card and it has a $10,000 credit limit, if you are spending $1,000 on that credit card every single month, that's going to be about a 10% credit utilization. Now, that is going to help your score and make you look more trustworthy way more than someone that's using $9,000, excuse me, of that $10,000 credit loan. So having that lower credit utilization is really going to help you. Now, these other categories don't make up a huge portion of your score, but I want to go over them quickly with you. The length of credit history. So, how long have you been a borrower? When did you open your first credit card or have your first student loan? This has an impact in the fact that we don't want you to close out your longest form of credit, your first credit card, because that could lower your credit score. New credit is going to look at how many loans have you applied for recently? How many credit cards have you been for? This is where if you are all of a sudden getting into miles and points and you want to travel and play the system, don't go apply for 10 different credit cards in 1 month. That could hurt your score. And then types of credit is going to look at your credit mix. And again, this is a small factor of your credit score. So I don't want you going out and taking out car loans just so it helps your credit score. But this looks at what different types of loans do you have? Is it a student loan, a car loan, a mortgage, a business loan? Having a mix can impact your score. So credit scores, they range from 300 to 800. And it's going to be very rare for you to have an 800 score and very rare for you to have a 300 score. But what I want to get across here is that having a good, bad, exceptional score does not define you, right? In general, if you have above like a 675 credit score, you're going to be looked at as a trustworthy borrower and you're going to get the loan that you're looking for. And anything above that is just going to help you get a better interest rate. So just keep this in mind, keep this range in mind. It's easy to Google to figure it out, but don't see like, oh, I have a fair score. That must mean I'm bad with my money, right? I don't want you to think that. Now, as much fun as credit scores are, it gets even more fun. There's different types of credit scores. So who here has heard of a FICO score? FICO score is a credit score. A lot of times those two words are used interchangeably, FICO credit, right? But not all credit scores are FICO scores. There's actually different types of credit scores. So one being the FICO score, the other being the Vantage score. They're basically developed by different people and used for similar but different reasons. Your FICO score is generally what's going to be pulled by the big lenders, like if you're getting a mortgage, where the Vantage score is typically going to be used by the banks to help you improve your finances. It might be what pops up when you log into your checking account, right? They have different ranges of the windows that they look at. They have a few different tweaks about them that you can see in this chart here. But overall, I just want you to know that when you see Vantage score, FICO score, think credit score. So again, why does this matter? Building credit can come into play a lot of different ways. But first, to build credit, there's a few things that you can do. So if you're brand new, let's look at what's on the left here. If you're brand new, you don't have any credit, and you decide after this workshop, hey, like that's something that I want to build. That's a financial decision I want to make. There's a few things that you can do. You could open a secured card, which requires a deposit, but it builds credit with responsible use. You could become an authorized user on someone else's card using their positive history to help you, but make sure that they are a good borrower. Or you could apply for a pre-approved credit card, student cards, credit builder loans, not quite as popular, but still options. And then let's say you already have a credit score and you just want to work to improve it. You have a loan that you're looking to take out, you want to get a mortgage. There's a specific reason why you want to build your credit score. Well, first, pay your bills on time. Always pay your bills on time. Two, if you want to play around with it, figure out what your credit utilization score is and try to keep that below 20%. And then lastly, avoid too many new accounts. If you're going to take out a mortgage, don't go open a bunch of credit cards beforehand. Wait until after, right? So that covers credit scores. I know, hopefully, I haven't put you all to sleep yet, but Janice is going to dive into the fun world of credit reports and credit bureaus with you now.
All right, thank you, Dana. Now that you guys know what makes up your credit score, let's talk about where that information comes from. You have your credit report, and we're going to talk about the three main bureaus that actually compile this information. So your credit report is a financial report card, right? Just like when you're in school, instead of, checking your grades, you can have your personal information, your credit accounts that are open and also those that are closed, payment history, any public records. This could be, bankruptcy, things of that sort, and also credit inquiries. So this is kind of where you're going to find all the information that you need about your specific credit history. And who are the credit bureaus? So we have three major players. We have Experian, Equifax, and TransUnion. Each bureau gathers data from different lenders, banks, creditors. Not all of these banks or lenders will report to all three of them. Some of them might just report to Experian. Some of them might just report to TransUnion. That is why there are three different types. And there's also slightly different scoring processes between how you're going to get a credit score depending on which company is reporting it. So when you look at one, you might see, let's say it's 775 at one, the other one might be saying 760, and it all kind of depends on what formula they are using specifically to calculate your credit score. Since all three of them can vary slightly, it is a good idea to review all three of them to kind of get an overall average so you know what your average credit score is. And the great news about this is that you can get a free copy of your credit report from each bureau every week at annualcreditreport.com. I know the website is a little confusing because it says annual credit report. Up until I want to say the last year or so, you could previously only check and get this free credit report once a year. However, they have since updated the frequency and you can actually check it every week if you really wanted to. Not suggested. Nothing will happen to your credit score, but it's a little much. However, a recommendation is to check it quarterly, maybe even bi-yearly, but at a minimum, checking it yearly. And now we'll go into what we're going to actually check for in the report. 1 in 4 credit reports has an error. So mistakes are very common. I would say, especially if you have a more common name, the chances of you getting somebody else's information on your report is going to be very high. So we want to check for incorrect accounts if you did not open an account up. Addresses, that's very common of previous addresses that you supposedly lived at could be mixed up with other people, outdated information. You want to make sure we highlight those errors as soon as possible and dispute those mistakes online. The bureaus have to investigate and respond, usually within 30 days. And correcting errors can improve your score and also protect yourself from identity theft. Actually, one of my good friends, her husband, just got his, I don't know if it's identity stolen. However, he got a huge loan that was taken out in his name to go back to school. He's been out of school for a while. However, somehow they were able to do it, and that's actually where he spotted it was on his credit report. Unfortunately, one of the protections that a lot of people do not use that is very helpful is freezing your credit. What this means is, in order for you to take a loan out, a company is going to have to inquire about your credit score, and they're going to put an inquiry in asking, "Hey, can I see this person's information?" If you have your credit frozen, they're not allowed to get that information. Um, so unfortunately, he did not have his credit frozen. However, he quickly spotted it and has submitted, police reports. So that is being investigated now. So if you want an extra layer of protection, especially after spotting any errors or fraud, it's great to freeze your credit. Even better if you do it now.
Yeah.
Now we're going to kind of go through different uses of credit in just different examples. But first, we're going to talk about the 5 C's of credit. This is kind of the overall formula that creditors will use to evaluate whether they want to provide you a loan for whatever you're asking for. So the first one we're going to talk about is character. So your character is your credit history. So on your credit report, it'll give you a detailed view about your credit history, meaning have you, paid on time? If you're paying on time all the time, that gives you a really good plus on this section. The next one is capacity. It measures your ability to repay the loan by comparing what your income is to what current debts or other loans you may currently have. So let's say you already have an auto loan, you also have a mortgage, and if it's a large mortgage, there's a chance that getting approved for other types of loan might be more difficult just because you have a lot of debt that's already out there. But that's where a debt to income ratio, a DTI, is usually used. And they depending on the situation, they like to keep in that like 35-ish percentage range. It's not a set in stone, but a lot of lenders like to be below that ratio. Next one, capital. This is what money can you put towards the loan. For example, if you can put a large down payment on a house, then the lender is like, okay, that's seen as a good thing. You have a big chunk of money that you can put down as a down payment. So you are, in their eyes, more likely to be able to pay the loan back or the mortgage back. Fourth, collateral. This can help a borrower secure loans. For example, we have something like an auto loan. So when you take out a loan for a car, if some reason you don't pay, they're able to take the car back. That's the same as when you get a mortgage on a home. Your home, until you pay it off, is considered collateral because they can repossess it if you decide not to continue paying your monthly payments. And the last one is conditions. The length of time that an applicant has been employed at their current job, how their industry is performing, and future job stability. If you've been working at, a job for a decade, they're going to be a little bit more open to giving you a loan versus your last 3 months show, hey, you just quit your job. Maybe you decide to start a small business, which is great, but they're going to see that as being very risky at that point in time. So all 5 of these kind of put together and will determine whether you get a loan. And then the second is, are you going to get a better rate on your loan? So we will move into the first example that we have, which is for Sarah. We're talking about a mortgage. So Sarah is someone who has a credit score of 760. She always pays her bills on time, a low credit utilization, and a low debt to income ratio. So, in the eyes of the lender, this is a low risk borrower. What this means is if you look at Sarah's, she could probably get an interest rate of 7.162, estimated monthly payments of $2,000. And over the 30 years of that mortgage, we're paying about 700, almost $725,000. If you go typical borrower, which has a credit score of 680, the risk level is a little higher. And then the interest rate you can see is just going to be a little bit higher, which means your monthly payment and your total overall cost is going to be higher. So when you compare Sarah's lower rates, she can save up to or more than 57,000 in the long term, um, just because she has a higher credit score in comparison to someone who's kind of at that borderline, just able to get that mortgage. Next example we have is with an auto loan. David here has a credit score of 620, has several late payments in his history, and has a high credit utilization, so greater than 50%. In the lender's eyes, he's considered a higher risk borrower. So David here is getting a rate of 7.8, monthly payment of 416, total 5-year cost of almost $25,000. Someone with a higher score, considering low risk, will get a lower interest rate, lower monthly payment, and overall looks like about $2,000 less than what David would pay in the 5 years. The next one we have is Maria. Maria is looking to open up a new credit card. She is a recent graduate, so her credit history is very short. Accounts, she has 1 to 2 accounts, all paid on time and no missed payments. So that part's great. But because her credit history is short, there's limited data. Therefore, she's kind of in the middle in the eyes of a lender. So for her, she'll probably still get approved, but the limit that she's going to be offered is going to be much lower, especially if you're getting kind of like your first card. Like $1,000 is a very common, even 500 sometimes, especially as like students, first time card holders. And the interest rate APR is going to be significantly higher. So this one's almost 25%. Whereas if you compare to an established user, 5+ years with the same conditions, no missed payments and whatnot, their credit limit is going to be significantly higher, obviously dependent on income as well. And their APR is going to be less. So if she continues her good habits of today, in the future, she'll be able to get better offers. And our last example here we have is Thomas, who's trying to get a personal loan. So Thomas has a 700 credit score. His recent activity, he's had multiple applications, meaning he has several hard inquiries on his report. So in the eyes of the lender, even though his credit score is really good, they're a little cautious because they're like, hey, why is he looking to get a lot of, it could be the same type of loan, doesn't matter. It could be he's trying to open up credit cards, then he's applying for a loan. They're just like, there's too much activity. And so if he's likely to, the approval is likely to be less. There's a chance of him even being denied because he has so much activity. Whereas if you don't have any activity in the last 60 days, approval is going to be much higher. So if you're going to, I think this is very much so for if you're going to buy a house. When you try to apply for a mortgage, they're going to look at, I think at least the last 3 months, some places even more, depending on your credit history, to see what hard inquiries you've had. The more, credit you're trying to take out, opening new credit cards, getting a new car loan, they're going to see that as like ooh, that is very risky. They're more recently opening all these things up. Are they able to also pay up, the mortgage? Because this has happened in the last 3 months. So if you are looking to buy a house, make sure you don't open up new credit cards in that time frame, get new other loans, make your credit report very boring is kind of what we're going for. You want to be a boring person saying, I got the money, give me my mortgage. So these are all kind of just different scenarios on what you could be getting depending on your credit score and also just your activity that you are doing. So now Dana is going to actually talk about whether credit is necessary.
Okay, I was a little fast on the gun with um the screens. Anyways, my favorite question, to credit or not to credit. So in the United States, we have this huge credit system, and it makes up so much of our financial decisions, especially when it comes to the financial decisions of the banks and the financial institutions. That being said, it is not mandatory to survive and be financially successful to have a credit score. It is a common piece of advice to start building credit early and have a good score so that you can use that as a tool to make financial decisions down the road. For example, if you start building credit when you're a teenager with a credit card and you're really responsible and you have a 750, almost 800 credit score, when you go to take out a mortgage, they're going to be like, oh, great, sounds good. This is awesome. If you have all those other five C's in place, it might help you get a better interest rate. That being said, let's say you grew up and your parents didn't teach you a lot about money and you didn't take out a credit card in high school. And when you did, maybe you realize that you're not so good at paying that off every month. And you don't really want to take out a car loan because you would rather pay cash for it and you don't want the debt hanging over your head, right? These are really important decisions that you can make, and one results in a credit score, and one results in no credit score. Not a bad one, just no credit score. And so I could go on and on about this all day long, but I want you to walk away from this workshop knowing that if you decide to play the game without credit, that is going to be a completely different game as playing the one where you want to build credit. And they are both equally good options. They just have different pros and cons. No matter what, credit comes with risk. Credit is debt. A credit score shows how you use debt, right? But no credit score, if you ever need debt or want debt in the future, doesn't give you the history and the backing to prove yourself. And there's ways to go about doing each one. And I encourage you to do your research. And if you just were told, like, hey, I need a good credit score, I'm going to build credit my whole life, I encourage you to think about it and ask yourself, like, try to break the system, try to break the rules and figure out, okay, is this something that I made a conscious decision about? Or is it just something that I was told to do? So I did it. So with that, I will leave you to ponder the question to credit or not to credit while we talk about some common mistakes to avoid if you do choose to go down the credit route.
All right. We've talked about this multiple times throughout this workshop, but common mistakes to avoid. Late payments. That's probably one of the number one items because it's a huge percentage of what, contributes to your credit score. So we want to make sure payments are on time. Auto pay is a great thing now that we have. So to make sure things get paid. And we're not talking about just pay the minimum. We're talking about pay in full because we don't want to be accumulating debt. The other one, maxing out credit cards. So this is the credit utilization. We want to keep it low. And there's sometimes you might have a big purchase. Like that is why you have a larger credit limit. And if you do end up doing that big purchase and you're like, oh, my credit utilization is way higher than normal and above what I want it to be, you can actually pay off and or pay down what's charged on your card because the utilizations actually calculate when your statement closes. So in between that last statement and the next statement, you have a big purchase, it posts, you can actually just immediately pay that big large purchase off. And by the time it closes again the following month, your credit utilization will be your normal. The other one, too many new accounts. As Dana mentioned, we don't want to open 10 accounts, within a month. Regardless what type of accounts they are, that is way too many. And probably after the third one, at most, they'll start denying you. And you don't really want to have a bunch of hard inquiries and then get denied for whatever you're trying to open. And then the last one is closing old accounts. There are people who want to play the credit card game. So closing accounts is going to happen at some point. However, the oldest account you have, um, regardless what it is, you should keep it open and have like one reoccurring um, item, like let's say your Netflix subscription. Just have that on that old account because that'll keep the account open and it'll increase your credit history length of time. And that's what's important is your average history of time. Whereas like if you have some newer ones and you're like, I don't want to pay this annual fee anymore, we can always look to downgrade to a free card. And if there's no option, at least have it open for a minimum of a year. A lot of companies do not like to see cards closed with less than a year. So we want to at least keep it open for a year and then downgrade or close it.
I want to hop in here. I would say, and we didn't talk about this, but the biggest mistake that you can make when it comes to building credit is going into debt unintentionally. A lot of people will try to build credit because they were told they need a really good credit score, but having debt, having credit card debt, student loans, car loans, mortgages, right? Doing that unintentionally just to build your credit score is probably one of the bigger mistakes that you can make. So just throw that in there.
Very true. Good point. All right. Some different credit myths. So, myths. Checking your credit score hurts your credit. It does not. When you check your own credit score through any of the three bureaus or through annual uh, credit report, freecreditreport.com, it's considered a soft inquiry, meaning you're just looking for informational purposes, so that has no impact on your score. When you have a hard inquiry, that usually means you're trying to apply for new credit, and that is what would affect your score. Um, and as Dana said, you need to carry debt to have credit. Not true. Um, we want to use debt strategically to build credit. Carrying a credit card balance builds credit. Same thing. No, it doesn't. Um, what helps is making sure we keep under that utilization and we are paying in full the monthly amount or the statement amount, not just the minimum amount. Having a higher income helps your credit score. Income isn't necessarily part of your score. Um, it's more on potential credit limits, especially with credit cards. So it's actually not part of your credit score, but it has some impact if we're specifically talking about credit cards. Credit repair firms can purge a bad credit history. So that's going to be a lot of people, trying to prey on those who are having some trouble with their credit. They cannot erase anything that has happened. Only time and better habits can do that. So if someone's telling you, hey, I can get that off your, unless it's wrong information, that's a totally different story. But if it's, your information that were, let's say, I think, my parents, they had to file for bankruptcy probably a decade ago by now. That stays on your credit history for 7 years. So up until it is now gone because it is past 7 years later, but up until that point, no one can say, "Hey, I can erase that off your record." It's going to be there until the time has expired. So the only thing you can do in the meantime is to make sure you build those better habits.
Awesome. And just to leave you with a few credit truths. Credit is confusing. The rules, the terms, the impacts of your credit can be hard to understand, even for adults, even for us coaches, right? Even for professionals. And it's okay to have questions and to seek help and do your research. It's also okay to decide, like, I don't need to understand everything there is to know about credit, right? It's confusing. Know what you need to know, and you can leave the rest to other people, right? Second, your credit score does not define you. I talked about this at the beginning, but your score is just a number. It reflects your financial activity. It does not reflect your value. It does not reflect your character or even your potential. Everyone can improve their score over time, but it does in no way impact your worth. And lastly, credit is a tool, not a crutch. That's what we wanted to leave you with today. Credit should be used to help you reach your goals. Debt, loans, credit scores, right? They should be used to help you get where you want to go in life and financially, but not as something that you rely on for daily spending or to solve financial problems. So with that, this is now my favorite part. We are going to move on to our Q&A session. So this is where we hop in for a little bit of live questions, live coaching. We have a few questions that came to us earlier, but if you do have any questions, we would love for you to put them in the chat now. We would be happy to answer those, and hopefully they will help someone else. While we talk through those questions, here is our contact information. If you want to save that, if you have any follow-up questions or want to get a hold of us, please reach out. We love this. We love teaching about money. We love coaching about money. So we would love to talk to you and do what we can to help. So, one of the first questions we had before this session is, what do coaches do when it comes to credit? Janice, how can a financial coach help when it comes to your credit?
So a financial coach can help, I think first is even looking at credit scores. That's something a lot of people don't even look at or even know what their credit score is. So I think a lot of it's the education of like, okay, this is what we need to look at, helping make sure things look correct on their credit report. And then we also kind of go through credit building strategies, explaining different tactics on how we can increase the score, how we can establish positive payment history, and then depending on situation, we're talking about like what types of credit cards to potentially open to kind of get started. If we haven't gotten started, or if we have a low credit score, then we can look at other options like secured cards, or credit builder loans to help build that credit score.
Yeah. Speaking of new cards, one question we got is, what do you recommend for your first credit card? And I actually created my free resource to answer this question. And so we have some of our favorites, and there's tons of sites out there that can list their favorites for different reasons. But when you're picking your first card or any new card, there's the process of deciding what your goal is when it comes to that credit card. So download that free resource on the next slide, and that will answer that question. Janice, if you want to get into travel points, what's the best way to redeem them?
Ah, that is a extremely long topic.
Yes.
However, most of the time, if we're talking specifically about travel um, redeeming them in the actual portals, for example, Chase's portals, Amex's portals, is not going to be what you want to do. You want to actually transfer to their partners. So let's say you're trying to take a flight to Japan. We want to look at, which airlines that, Chase might, transfer to. Sometimes there are bonus points where it's like every 1 point you transfer, you get 1.5 points. And they're not always the best. So it's a very strategic game. You have to do a lot of research online. Sometimes you got to wake up in the middle of the night because, they come out at their midnight or, their 7 a.m., not our 7 a.m., those kinds of things. But a lot of times for travel, we want to transfer to the partners that they work with to actually redeem better flights. Flights are
Yeah.
probably one of your top areas that you can redeem and get really good value.
And one thing that I would mention on that is you don't have to like be a points and miles genius. If you just keep the rule of thumb, like 1 point to 1.5 cents, it's going to be a really decent return on value of your points. If you're doing like a 1 point to 1 cent, so let's say you have 1,000 points and you want to take out, or sorry, let's say 100,000 points and you want to get a gift card, right? Looking at that 1 cent ratio is typically what you would get on a 1 cent to a point, right? But if you're transferring it, for a flight, that's where you might be able to get a 1.5, or you might be able to finagle it. There's instances where you can improve that ratio even better, but if you just want to play with it a little bit and not be so into the world of miles and points, just keep an eye out for that ratio. I have a few more questions, but we have one in the chat. What is the downside of freezing your credit? Are you not able to improve your credit while it's frozen? Freezing credit is recommended by so many people in the financial industry because it is such a good way to protect yourself from identity theft, from fraud. Talk to us a little bit more about that, Janice.
I'd say the downside of freezing, sorry, we'll start with the second question. Are you not able to improve your credit? Your credit will continue to improve because if you already have things that are in your credit report, let's say a mortgage, credit card, those things will continue to increase your credit history length. If you're paying on time, it'll make you look better in the eyes of a lender. The downside of freezing your credit is the small uh, annoyance that anytime you want to apply for a new loan of some sort, that you need to unfreeze it. So that is probably the one downside. But what we're trying to combat is what Dana said is we don't want fraud. We don't want identity theft. So that is the little bit of annoyance that you're going to have with having to unfreeze your credit to apply for new credit. Is probably countered by making sure nobody else tries to open something in your name.
But you're also probably not applying for new credit every month or even every,
True.
few months, or some people do it only every few years. So freezing your credit, especially if you're not going to be pulling your report quarterly, then it's definitely recommended. And I believe, Janice, your resource, which I will share now. So these resources for you guys are here to help you. One, how to freeze your credit. So this is something that Janice created, just a quick guide for you to be able to go online, follow the steps, learn how to do it. You could do that today before we get off this call while we're talking, right? The next one is how to choose a credit card, figuring out which one is right for you. So I will put these links in the chat as well so that you can download them if you don't want to scan the QR codes, if you're on your phone or something. But while I do that, my last question I have, or one of the last ones, is how long does it take to see improvements on your credit score? And the answer is, and Janice, you can hop in here too, but the answer is 3 to 6 months typically. If you are a new borrower, it's usually going to take at least 6 months to see a credit score at all. And then typically you're not going to be seeing at least your FICO score improve like on a daily basis. Remember, we talked about the Vantage scores that you might see more consistently, see it go up and down. One thing that we wanted to mention is if you see your score go down, don't freak out. It's probably temporary. It could go right back up shortly after that. But if you have a goal of saying, like, hey, I want to be debt free or I want to pay off a credit card, paying off that credit card might cause your credit score to dip a little bit. But I don't want you to not pay off the credit card because of that. It will go back up, or you might find that you don't really need your credit score to go back up because you're not taking on any future loans, right? So don't let your score stop you from reaching other financial goals. Any other questions? If you have them, throw them in the chat. I will stick around to do some coaching. If anyone has questions after we stop the recording, we can do it more private. But if not, we really appreciate you guys being here. We wanted to let you know that we are hosting another workshop, our last one of the year in December on year-end financial review. So this, we're going to cover everything that you can do or should do with your money before the year is up or to start the year off strong. This is a great topic. There will be something for everyone in it. So we encourage you to sign up today so that you get the calendar invite and you don't forget. You'll get the recording if you're not able to attend. And we would love, love, love if you share these workshops with people in your community, people that you know could benefit from them. We do this because we love it, and we do this workshop as a way to kind of give back to people that either aren't able to be our clients or don't have the resources available for that. And so please share it with someone that could benefit from it. Thank you all for being here. Again, I will be pausing the recording and I hope you all have a great day. Stick around if you have any other questions.